Well, good morning, everybody, and good afternoon to you as well. What we're going to be talking today is the private employer benefit tax mitigation strategy. And this PowerPoint is designed to give you an overview, demonstrate how it works. It's, in general, a tax mitigation tool, and secondarily, and perhaps every bit as important, it provides some significant benefits for the plan sponsor, that is, for the employer, for the owners of the company, and for the employee participants as well. So the great news about it is it's a real win-win situation. Now, this is not a new strategy. These things have been around for a number of years, and in fact go all the way back to 1997. Oftentimes we find that current advisors are simply not aware of these tools. There are only about 15,000 employee stock ownership trusts and these types of plans available in the United States at the present time. So there's not a whole lot of them out there when you consider that there are several millions of small businesses out there. These programs were first made available in 1997 with the passage of the Small Business Jobs Protection Act, and there were modifications made to them, the most recent ones being with the Patient Protection and Affordable Care Act of 2010. The good news about these is that these types of tax strategies are available to virtually any business strategy. It does not matter if you're a C Corp, a professional corporation, a limited liability company, a partnership, and even a sole proprietorship. It also is broadly applicable to virtually any type of business. So whether you're in manufacturing or in sales or some sort of service industry or a professional entity, you can take advantage of these strategies. Now, there's a lot of different tax code that goes into the creation of this, so they are quite complex just from the outset. As you can see from this slide, we have multiple sections of the Internal Revenue Code that have come into play here, along with ERISA regulations, Treasury regulations, revenue rulings, and various acts of Congress. These are all important, and what I like to do is refer to this as my closed course professional driver slide, because you do not want to attempt this on your own. You need to have someone who has expertise in federal law, someone who knows labor law, and someone who knows corporate law. In addition to that, they've got to be familiar with the rules of ERISA, the Employee Retirement Income Security Act, and that is the set of doctrines and law that govern how employee benefit plans work. Looking at our next slide, what we have is an example, and I'm using a doctor's practice here, the Michael J. Smith, MD, Professional Association. We start with an operating company, and that operating company must have certain characteristics. First of all, it has an entity that is affiliated with it. Dr. Smith owns a real estate entity that in turn owns the practice building and some other pieces of commercial real estate. So we have an operating company and an affiliate that is part of a controlled group of companies that Dr. Smith owns. We need to make this operate a minimum of 11 employees. Now, 11 employees are required by some of the labor regulations in the Internal Revenue Code under Section 409P. And that's a pretty arcane and specific piece of legislation. But essentially, we need 11 people who are unrelated so that we avoid any of the attribution and disqualification rules of the Internal Revenue Service. This is exclusive to privately held companies. We do not work with public companies. Frankly, with the passage of Sarbanes-Oxley several years ago, that made ESOPs in the public sector very, very difficult to pull off. The other thing about this is that there has to be a threshold for tax liability. And so when we look at the overall tax picture of Dr. Smith and his companies, we must have a combined tax liability of $250,000 between the individual owner, in this case the doctor and his wife, and the corporation, his professional association, and the real estate affiliate. So between them, they've got $250,000 in taxes that they're paying at the federal and the state level, and that is what we're solving for. That's what we want to mitigate. We also want to make sure that all of the key advisors are involved in the plan. So in Dr. Smith's case, we have his financial planner involved, his CPA is involved, and he also has an outside corporate counsel. So we want to make certain that key advisors are always part of the planning team. And frankly, if a key advisor does not recommend in favor of the program, then we simply won't install it, because that key advisor probably has more knowledge about the doctor than we do. So we start with an operating company, and the operating company must have those specific characteristics. We next form a new entity, and that new entity, for our purposes today, we're calling Acme Services, Inc., ASI. Now, Acme also has to have certain characteristics. It's an administrative services company, so it's going to be set up with the specific purpose of providing services back to Dr. Smith's practice. It is going to be a Subchapter S corporation. That Subchapter S corporation is important because a Subchapter S corp is one of two entities that can be established and sponsor an employee stock ownership trust. Now, Dr. Smith controls the ASC. He is the director, he is the officer, he is the trustee of the administrative services company. So he's going to be involved at it from the standpoint of representing the shareholder. He's going to be involved in it from the standpoint of being a director and officer of the corporation as well. Now, the entity is going to be a specific purpose entity. It's going to be designed to provide very specific business services and create economic benefit for his company and his affiliates. That is important because the IRS looks at any kind of tax-favored transaction through the lens of, is there a real economic benefit there other than the tax savings? And in our case, in every single case of all the entities that we've established, and we've now done almost 260 of them, 258 to be specific. Of those 258, every single one of them is different. They are all established, and the administrative services contract function based upon whatever the economic benefits are that are specific to the case for those business owners. So they're all very, very custom designed. There is no one-size-fits-all here. Now, the administrative services company, when we put it together with the practice, you can see we have on our left the operating companies, and on our right we have our new administrative services entity. And what we do is we form a contractual relationship. Now, that contract is designed to allow MJS, the operating companies, to take a deductible expense for any services that are rendered by Acme. We're creating an ordinary and necessary business expense trail here, and we are doing so using a contractual relationship. Acme, in turn, will provide administrative services back to the operating company, and those services can include things like HR functions, employee benefits, marketing and advertising, financial services, purchasing, and so on. In other words, anything you would typically use a third-party contractor for, Acme Services can in fact provide. Now, this contract is an annually renewable instrument, and that becomes important when we attribute a value to it. And it also allows us the flexibility of either severing it, changing it, editing it, modifying it as we need to as we go through the course of a year. The contract, again, is very specific to the entity that ASI will provide to benefit that operating company. So in this case, in the doctor's practice, it also provides some unique things such as billing and coding services, provides client confidentiality or patient confidentiality for HIPAA purposes, and it also deals directly with the insurance companies when it comes to collections. So Acme Services is providing real, tangible services back to the practice and to the real estate entity as well, and those create a deductible expense. So the contract is kind of pivotal to the structure. So what we're able to do at this point is shift money from MJS over to Acme Services. And what we're doing here is we're identifying services that are, again, real, tangible, and provide an economic benefit back to the practice. Next step is when we put it together, and this is where it gets interesting. As you can see, we have a smaller version of our previous slide on the screen with the practice and the operating entities on the left, Acme Services, Inc., the management entity in the middle. And what we have done now is we've added a very unique shareholder to the picture. Acme Services will be owned by an employee stock ownership trust, an ESOT. Now that ESOT has been around for now 17 plus years. It is allowed through the Taxpayer Relief Act of 1997, and that allows an employee stock ownership trust to own an S corporation. Acme Services is 100% owned by that employee stock ownership trust. The ESOT is a qualified plan. So money that is held for the benefit of the ESOT participants is both pre-tax and tax-deferred. So what is the net effect of this? If we have an ESOT as a shareholder of an S corporation, well, an S corporation is a pass-through entity, and because the ESOT is a qualified plan, it reports income just like any other taxpayer would, except it does not pay taxes. So it files a Form 5500 as part of its tax filing, and that 5500 shows that income has been created. However, no taxes are being paid on that income. So what we do is we wind up conferring a tax-exempt status on Acme Services because of its ownership by an employee stock ownership trust. Now, an employee stock ownership trust, as I mentioned, is a qualified benefit plan. All of the employees of both the practice and Acme Services receive a part of that benefit. And that benefit is in the form of a trust obligation to pay a retiring employee upon retirement, normal retirement age at age 65. As a qualified plan, the ESOT also confers a huge level of risk management. In effect, it is very, very difficult to sue an ESOP. They are rarely sued, and in instances where they have been sued, more times than not, it is not a successful pursuit in the legal system. Qualified plans are very, very difficult to penetrate. Now, the one exception to that is something called a QDRO, Qualified Domestic Relations Order. If an employee participant receives a benefit and he gets a divorce, the wife is entitled to part of that benefit, or the husband is entitled to part of that benefit. So you have a much higher level of risk management and asset protection when you have this kind of structure. So when you put it together, what you have is the ability to move money in the management entity. That money, however, is untaxed, so it is the equivalent of $1 when you move it in is still worth $1 when you want to spend it. Whereas if we left the money in the practice, it would be diluted by state and federal tax, probably up to, in the case of Smith's practice, which is in California, somewhere around 55% tax between the state and the feds. So the ESOT, being a tax-deferred entity and owning Acme Services, allows us to recapture all of that money, that 55 cents of every dollar that ordinarily would be taxable. So that's a very, very strong piece of leverage right there. When we put it together in total, it looks something like this. We have, again, the management entity in the middle. On the left, we have our operating company. On our right, we're showing the shareholder, our federally qualified tax-exempt trust. And again, that shareholder confers tax-exempt status on Acme Services. And when we set these up, because we have an employee plan, we first have an obligation to allocate money for the benefit of the employees. And we do this not as a cash deposit, but rather in the form of stock that is allocated based on the individual's payroll, the individual employee's payroll for his or her benefit. Generally, the higher the compensation, the higher the benefit for the employee. So we first, when we set these structures up, look towards creating that employee benefit because that, quite frankly, gives us our tax shield. That's what gives us the employee stock ownership trust. Now, the money that is remaining, and generally that is about 90% of all the money that has been moved in to Acme via the contract, is available for any legitimate business purpose. And that money can be used in many, many ways, and here are some examples. We've used it to create a financial services mechanism wherein, for example, if we want to finance a acquisition by the business owner, we can do that, whether it's a new building, a new piece of equipment, operating capital to go out and start another company or purchase a competitor. So financial services is definitely one of the things that is done in more cases than not. The second area that this is used in is in the area of creating key man insurance. Key man insurance, while very desirable for most companies, particularly those where you have partners, is not a normally deductible expense. But if we're paying for it with untaxed dollars, that makes the acquisition of that insurance much more palatable and, in fact, allows us to use the equivalent of untaxed dollars to purchase that insurance. And because of the contractual relationship between MJS and Acme Services, that key man insurance can be purchased and applied over at the operating company as well. That contractual relationship creates what is called an insurable interest. We also can use the money to make investments. If the principals of Acme and MGS decide they want to create a holding company, use it to invest money in various enterprises, whether it's real estate or Wall Street types of investment securities, they can certainly do that. And money is oftentimes used to do that and to create a return back to Acme Services. We can use it for cross-purchase agreements. If Michael had a practitioner that he wanted to bring on as a young associate and have him groomed to take over his practice, the use of cross-selling agreements allow us to create that scenario where we can set aside monies for that exact purpose to protect the corporation and at the same time create an exit strategy for Michael. For purchasing various types of equipment. Oftentimes, medical equipment is extraordinarily expensive. This can be used to create a downstroke for the purchase of that equipment, and it also can be used to purchase that equipment, again, on a pre-tax basis. If I buy an MRI machine, and it might be, say, $1 million, $1.2 million, that's a lot of money. However, if I use untaxed dollars to do it, that gives me significant leverage, in this case about 55%. Furthermore, I don't have to wait to amortize and recoup my costs for that piece of equipment because I've already used untaxed dollars to purchase it in the first place. So, in effect, I get a double benefit because I'm using untaxed dollars to purchase it. I get the leverage of using those untaxed dollars immediately, and then I get to go ahead and depreciate the cost of that equipment over several years, whether it's 5 years or up to 20 years. We can make loans from the administrative services entity out to related entities, whether it's corporate officers, employees, other related affiliates such as the real estate company. In this case, that real estate entity can use money to purchase new commercial investments and so on and so forth. So as you can see, there's a broad flexibility with what we can do with the money that is moved into Acme Services. We start the process by identifying how much tax is currently being paid at the practice level and by the principals. And from there, we go ahead and do an analysis and determine how much could be flowed through the structure and what kind of tax savings could actually be generated. So it's broadly flexible, very, very malleable in terms of how we apply it to different types of operations, and it's a structure that is proven. We have been doing this particular structure now, of course, taking into account modifications to the Internal Revenue Code and various changes in the law that Congress has implemented, but we've been doing this now for 17 years, almost 18 years. We have had 7 different examinations by the Internal Revenue Service. Each of those has been a no-change audit, no-change examination. So we're very, very comfortable defending this. I'm going to go ahead and open it up to questions. So I would welcome any questions that you folks might have.
Let me ask you something, Lex. Why haven't I heard of this before?
Well, it's a very unique structure. That's an excellent question. There are, in fact, about 15,000 of these that have been established in the United States since 1997. Employee stock ownership trusts in general have actually been around since 1956. In 1974, they became part of ERISA. But it's a very highly specialized area of practice. For example, you must know the tax code, you must know labor law in the form of ERISA, the Employee Retirement Income Security Act, and you must know corporate law. So you've got to have a combination of those 3 disciplines to really understand how these things all come together. But the reality is there's about 15,000 of these out there, and you have companies such as Lowe's, Home Improvement, Home Depot, Hertz Rent-A-Car, United Airlines. All of them have some variation or another on this structure as it exists today.
Okay. And in your opinion, Lex, what would be the positive, and if there is any, what would be the negative of this plan for somebody?
Great question. The positives would be the immediate recapture of tax dollars and the ability to put that money back to work in business operations. So very, very strong positive. Second positive would be the ability to immediately leverage that money. In effect, if we're saving taxes, you're saving anywhere from 40%, 39.6% federal, all the way up to, in some cases in California in the higher income brackets, 72%. And putting that money back to work. So that's the big positive. The negative, if there is one, is that it's a complex structure. It requires some shepherding on the part of tax professionals such as ourselves to make sure the structure is working, is compliant with all of the regulatory environment that's out there. You are going to be required to create another set of books, in effect, to operate a second corporation, if you will, all of which is by the way, is parsed out, so it's subcontracted out, if you will. But it adds a layer of complexity. As far as risk of audit, there is no huge increase in risk. What we found with 258 structures in play and 7 audits, that puts us at around 2% in terms of possible risk of audit. So there is no increase in audit risk on this. In fact, every audit that we've ever been involved in, we've been successful. We prevailed. So that's the good news there. But I'd say the complexity is probably the one drawback to it. And that's probably why you don't see a whole lot of these things out there. I mean, 15,000 out of roughly, more than 2.5, 2.75 million small businesses. That's not too many.
Okay. And just the last question, what would be the next steps if I wanted to see what it would do for my company? What would I do next?
The next step would be to fill out a feasibility questionnaire. That feasibility questionnaire is pretty simple. It asks basic financial information, and it's a one-page document followed by an employee census. So fill out the feasibility questionnaire, work with your CPA and your financial planner to do that. That information then comes to us. We do a preliminary analysis. We then have a telephone conference with you and your professional advisors. If you are interested in pursuing it further after that, then we ask for financial information, and the financial information is typical stuff that any business owner would have access to, things like your profit and loss statements for the last year, your tax returns for the previous year, employee data, just basic things. And then we do a more formal analysis. We actually spreadsheet out what the potential tax mitigation would be, how much can we actually save, if anything, in tax. And generally speaking, I'll tell you that we're able to generally save between 60 and 80% of the taxes that are currently being assessed. And once we've got that data, you then need to make a decision. Is it something that you want to pursue or not? Very, very simply, we do our due diligence. We ask that you are very forthright and frank with us. Give us the scoop on what's going on with your business, and we'll take it from there. We do the analysis, and it's either going to work from a numbers standpoint or it won't. We advise you to seek counsel from your professional advisors, your financial planners, your CPA, outside counsel, and let's get the whole team on board. So pretty straightforward process, generally speaking, from start to finish. When we start an analysis, it usually takes us about 2 weeks, and we really are in a position after a couple of weeks to recommend to you either to go forward or not. So very, very simple stuff.
All right. Well, Lex, I thank you very much. My questions have been answered, and I don't have any more questions. Thank you very much.
You are most welcome. I look forward to going forward with you, and let us know if we can assist in any way possible. Thank you.
All right. Thank you.